This secret investing tool has been used by legendary investors like Warren Buffett, Jim Simons, and Bill Gross. I haven't been able to find Warren Buffett talk about it, but every source on the internet says he uses it, so it must be true. This strategy is used to determine optimal bet or investment size to maximize wealth. The tool is the Kelly Criterion. Watch until the end to see how traders and investors use this tool to optimize their returns. It was developed in 1956 by John Kelly, a researcher at Bell Labs, to reduce telephone signal noise. I found that fact on Wikipedia, but I doubt you guys care much about it, so we'll keep this moving. This bet strategy leads to higher wealth compared to any other strategy in the long run, but in the short run is extremely volatile because it suggests large bet sizes. Edward Thorpe decided to test the Kelly strategy in sports betting with someone he described as a complete novice. He put up $50,000 of his own money and used the Kelly strategy to estimate the proper bet sizes. They placed between 5 to 15 bets a day, and bet sizes ranged from a few $100s to several thousand each, and they increased as the bankroll grew. After 101 days of bets, they had a profit of $123,000 across various sports. Imagine being the guy he asked to pick his bets. You're down bad one day in a Vegas sportsbook, and some MIT genius says he'll pay you to pick his bets? Living the dream. Thorpe created a hedge fund in 1969 called Princeton Newport Partners. The fund was a convertible arbitrage fund, which is a market-neutral strategy. This might trigger some Robinhood bros, but Ken Griffin also got his start with this strategy. By 1998, Thorpe claims the fund returned 20% compounded with a volatility of 6%, with no correlation to the overall market. That means an investment in 1969 of $10,000 would have been worth $18 million in 1998, 28 years later. The optimal Kelly bet size is found by maximizing the expected value of the logarithm of wealth. Long story short, this means it finds the maximum compounded rate of return possible and suggests the fraction of your wealth that optimizes the growth rate. The Kelly portfolio sits on the efficient frontier. For those of you who don't know, the efficient frontier is a hypothetical risk-reward trade-off curve. Basically, it is a curve that connects all portfolios with the highest return for a given level of risk. So having portfolios below this line is suboptimal. You have more risk than you need to achieve that return. Simply put, if a portfolio isn't on this efficient frontier line, it isn't worth investing in. You could do better. Okay, let's take a look at these formulas. Hang in there for me. F is for?
F is for friends who do stuff together.
Nah. F is for the fraction of your bankroll or portfolio you should bet. B equals the odds of winning or the risk-reward trade-off. A good way to find B is to take the payoff if you win and divide it by the payoff if you lose. P is the probability of winning and Q is the probability of losing the bet. This version of the formula is best used in games of known payoffs like blackjack. Thorpe discusses how he used this in Las Vegas while counting cards in his book, Beat the Dealer. That sounds like a book we'd all read if we still read books. If you think about it, you probably replaced all the time you spent reading books with watching videos like this. Thank you for watching this video instead of reading books. Glad I could help. A version of this formula was derived to apply to the stock market. The fraction to invest is the mean return minus the risk-free rate or government T-bill rate divided by the variance of the investment. This adapted version of the formula can suggest very liberal amounts of leverage. Let's plug in rough estimations for the S&P 500 index into the adapted Kelly formula. 10% mean return minus 2% assumed risk-free rate divided by 14% standard deviation squared to get the variance. We get a result of about 4. This means the optimal Kelly bet size is to bet 4 times your portfolio. Although historically this bet size probably would have worked out, I doubt many people would want to take out loans to invest in the stock market. So because of this aggressiveness, investors often reduce the optimal Kelly bet size by some predetermined factor. The Kelly strategy is difficult to apply in financial markets because there are a wide variety of outcomes other than just a win or a loss. The easiest strategy to apply this formula to are option strategies with fixed payoffs. This means there is a known win or loss on the trade. An example of this kind of strategy is an iron condor trade. In this theoretical iron condor, the max gain we will make up and say is $250, and the max loss is $400. We will also assume the spreads are one standard deviation away from the current stock price. This allows us to estimate a win rate. If the spreads are one standard deviation away in a normal distribution, that would mean we win 68% of the time. Alright guys, come on, stick with me here. With all these factors decided, let's plug that into the model and really test this out and see if it works. Yeah, I can code, no big deal. Had to show off for the smart money team. First we must make a formula and assume the inputs. Next let's put together a little Monte Carlo simulation and we run this 500 times as a test. Finally, let's plot the optimal Kelly size versus other options like half Kelly and 2 times the Kelly fraction. As you can see, the full Kelly, as it's often called, ends up outperforming the other strategies, but is very volatile in the short term. The 2 times Kelly formula often is extremely volatile and an example of what happens when you overbet. Thorpe says in his 2007 paper, long-term investors ought to avoid using a greater fraction. Therefore, long-term investors should further limit their investment fraction enough to prevent a significant risk of overbetting. He continues on to imply the full Kelly should be thought of as a ceiling to not surpass when betting, and oftentimes some fraction of the full Kelly is better when considering other factors like longevity and uncertainty. The Kelly criterion solves an issue I know I was always running into. I have this investment idea, now how much should I put into it? Without any framework to figure that out, might as well flip a coin. In addition, even if you guys aren't going to use this in investing, take a look at some pages of how to use it within sports betting. I have a feeling the Venn diagram of people watching this channel and those who sports bet is basically just one circle. If you like learning about how to use this technique, watch this video to see if you can find a way to apply it.